Okay, so picture this. You find the perfect new home, and the builder offers you this amazing deal, a mortgage rate a full point, maybe more, below what everyone else is paying. It seems like a total no-brainer, right? But what if that good deal is actually hiding a huge risk, one that could put you deep in debt from the moment you get the keys? Well, it turns out this is happening to thousands of new homeowners right now. Let's dig into how.
All right, here's how we're going to break this all down. First, we'll look at the underwater problem and why so many new homeowners are already in the red. Then, we'll dissect that good deal from the builder to find the hidden price tag. We're going to see who is most at risk here, ask if we've seen this movie before, and finally, figure out what happens next.
So let's just dive right into the central mystery. We're seeing a really shocking number of people who just bought brand new homes, and they're discovering they already owe more on their mortgage than their house is actually worth. I mean, how is that even possible?
Well, the scale of this problem is honestly, it's alarming. An analysis of loans from one of the nation's biggest builders, Lennar, found that more than a quarter, 27%, of their recent buyers using government-backed FHA loans are already underwater. Just let that sink in. More than 1 in 4 new homeowners are starting out in the hole. And just so we're all on the same page, let's quickly define what we're talking about. Being underwater, or having negative equity, is exactly what it sounds like. It means if you had to sell your home today, the money you'd get from the sale wouldn't even be enough to pay off your mortgage. It's a really dangerous spot to be in for any homeowner, let alone someone who just moved in.
And look, this isn't just a one-off thing with one builder. For another huge builder, D.R. Horton, it's 18% of their FHA borrowers. This is so important because being underwater is directly linked to a higher risk of foreclosure. I mean, if you lose your job, you can't just sell the house to get out from under the loan. And while the national rate of 1.6% might sound low, that's actually the highest it's been in 3 years, and it's affecting nearly 1 million homeowners across the country.
So what's causing this? What's going on here? Well, the investigation points to one primary suspect, a really powerful sales tool that builders are using to get buyers in the door in this high interest rate world we're in, and that is the so-called good deal.
And you know, on the surface, a rate buy-down looks fantastic. The builder pays a fee to the lender, and in exchange, you, the buyer, get a mortgage with a way lower interest rate than you could find anywhere else. Your monthly payment drops, and suddenly that dream home feels affordable. I mean, who wouldn't take that deal?
But, and you knew there was a but coming, right? This is where we pull back the curtain, because that deal comes with a hidden price tag. And spoiler alert, it's not the builder who's ultimately paying it. Let's see how this thing really works.
So here's the catch. According to researchers at the American Enterprise Institute, the AEI, these buydowns aren't really a discount for you. They're a tool that lets builders keep their sales prices artificially high. So instead of just lowering the price of the house by, say, 10%, they offer you this deal on the rate while keeping the sticker price way up.
Let me put it this way. In a normal market, a house might sell for $400,000. But with a buy-down, the builder sells it to you for $440,000. They then use that extra $40,000 to pay the lender to buy down your interest rate. So yeah, you get a lower monthly payment, but you're starting out with a much bigger loan on a house with an inflated price tag. And that is exactly how you end up underwater from day one.
Okay, so right about now, you're probably thinking, wait a minute, aren't there rules against this? And yeah, there are, but there's a loophole. Normally, any money the seller gives back to the buyer, called a seller concession, is capped. But builders are using this thing called a bulk forward commitment. They pay one huge fee to a lender for access to a giant pile of low-rate money. And because that fee isn't tied to your specific loan, it's not technically a concession. It just flies right under the regulatory radar.
So that brings us to the really important question. If this is happening all over the place, who is shouldering the most risk? Who's getting hit the hardest? Well, if you follow the data, the picture becomes crystal clear.
And the difference here, wow, it is absolutely staggering. For loans made just last year, over 21% of borrowers with VA loans, that's loans for our veterans, are already underwater. For FHA loans, which are super popular with first-time buyers, it's 13%. Now compare that to your standard conventional loans backed by Fannie Mae and Freddie Mac, where it's less than 0.5%. The reason is that VA and FHA loans let you buy a house with a very low down payment, or sometimes none at all, which means you have no equity cushion to start with.
And we're not talking about some niche fringe strategy here. This has become the main playbook. AEI researchers estimate that nearly 2/3, 64%, of all homes sold by the biggest builders involve these rate buydowns. It's become the standard way of doing business in the new home market.
Okay, now let's add another layer of risk to this whole thing: falling home prices. If you look at markets like Austin, Texas, where prices have already dropped 21% from their peak, 7% of all homeowners with a mortgage are underwater. In Cape Coral, Florida, that number is 11%. So when you combine an inflated purchase price with a market that's already going down, the risk of ending up with negative equity just skyrockets.
So let me get this straight. A financial tool that pumps up home values and puts the most vulnerable, low down payment buyers at risk. If that's giving you a little bit of déjà vu, it absolutely should. We have to ask the question, have we seen this movie before?
And the answer is a huge, resounding yes. Before the Great Recession, there was a similar practice called seller-funded down payment assistance. It did the same thing: artificially inflated home prices and targeted government-backed loans. And the result back then? Those loans defaulted at more than double the rate of others, and it helped create a crisis that ended with a taxpayer bailout of the FHA. Just look at this timeline. It really puts things into perspective. And honestly, it's a little chilling. Back in 2007, that risky practice was used in about a third of FHA loans right before the crash. Today, these rate buydowns are being used in nearly 2/3 of all major builder sales. The parallel is just undeniable, and it leaves that big, scary question mark hanging over the future.
So, where do we go from here? Given everything we've just seen, the data, the risks, the spooky historical parallels, what is being done about this? What does the road ahead even look like?
Well, the good news is this isn't going totally unnoticed. The Federal Housing Finance Agency, the FHFA, which oversees Fannie Mae and Freddie Mac, has said it's looking into builder pricing and these risks. At the same time, the researchers who uncovered all this are calling for one very specific, very clear action: close the loophole.
And the researchers who dug all this up, they are not mincing words. Sissy Lee and Edward Pinto at AEI put it plainly. It is time for Fannie Mae, Freddie Mac, and the FHA to end this exemption. They're basically saying, hey, if it looks like a seller concession and it acts like a seller concession, then it needs to be regulated like one. Which leaves us with this final thought, doesn't it? The next time you see an offer for a new home that seems way, way better than what the market is offering, it's worth asking, what's the real cost here? The data suggests that for tens of thousands of recent buyers, the price of that good deal was starting their dream of homeownership already in debt. The real question is whether regulators will act before history gets a chance to repeat itself.